Okay, so today we're going to talk about the impact of ESG investing. All right, in case you don't know, ESG stands for Environmental, Social, and Governance Factors when making investment decisions. ESG investing, you could sort of divide into two broad categories, divestment and engagement. And so with divestment, we're selling, or at least not buying, companies that impose social and environmental costs on society. Okay. With engagement, this would be the idea of active ownership by shareholders that positively influences corporate behavior. So with that in mind, divestment is where we're gonna begin our talk. Now, it's something that you probably all know, but maybe don't think about that much. That just because you sell stock in a company that isn't consistent with your social and environmental goals doesn't mean that the shares of that company cease to exist, right? Anytime you sell your shares, necessarily somebody else is buying them from you. By lowering the price of these shares, we are in finance what we would term as raising the company's cost of capital. This is the mechanism. With lower investment capital, with more expensive investment capital, they are able to take on fewer projects that may be inconsistent with our social and environmental goals. And then eventually they play a smaller role in society and social and environmental costs are reduced. Now quickly, the same thing works in reverse for the companies that we're buying. We're raising their share prices by purchasing their shares. The higher share prices mean they can issue new securities at lower cost, right? Lowering their cost of capital, increasing their role in society and lowering environmental costs. Obviously, we've suggested that divestment occupies most of the bandwidth in the ESG space, but theoretical and empirical work in our field suggests that it would be very difficult to make any meaningful impact on society with a divestment strategy. Basically, it would take like 80% of all investors to have exactly the same views, to share exactly the same social and environmental goals, to change a company's cost of capital by even 1%. And first of all, 1% really probably isn't even enough to change the actual investment decisions within the firm. Most people invest in ESG products because they believe ESG will outperform the market. They're investing in these products because they think they're going to earn a higher rate of return. Lately, at least in the last decade or so, they've been somewhat right. Okay, so during the 2012 to 2020 period, stocks that we would consider by some measure to be green outperformed the broader market by a ton. So in 2020, the German government began issuing bonds that would, I don't want to get this wrong, finance its transition towards a low carbon sustainable economy. But every time they would issue one of these bonds, they would also issue an identical bond that would support the general operations of the German government. Okay? Now, but this is about as close to an experiment as we'll ever get. All right? We issued two identical bonds that are alike in every single way, except one of them is going to support this green transition, and one of them is just going to do all the other stuff that governments need to do. And here's what happened. From the day the bonds were issued, the green bonds sold at a higher price. So now, investors that are looking over the market and thinking, hey, I'm going to buy green investments because they have a higher rate of return, there's an example of a green investment that definitely has a higher rate of return if you look backwards. But it also definitely has a lower rate of return if you look forward. I bring this up because this induces a fragility into this market, right? If most people tell you that they're doing this because they want to make money, then when it comes to times when they may not make money, maybe they're quicker to stop doing this, right? And I think we saw that during the early days of the pandemic for sure. Most mutual funds saw outflows during that era, but green funds, ESG funds saw massive outflows during that era. When times got tough, people didn't really stick with it, all right? we think of ESG investing as trying to promote some social change, to change the world through our investment choices. But in reality, ESG investing is probably just a way to design a portfolio that's capable of responding to a changing world. Okay? Being reactive, not proactive here. Instead of changing the world, I'm hedging myself against a changing world. So what can we do to actually try to make a difference? BlackRock, I'll start with them, has recently announced that they're going to roll out a new vote collection system for their institutional investors, right? So that their goals and desires can be reflected in shareholder proposals more clearly. So Tumelo is a voting aggregator service, right? So new idea, you tell them what your investments are, and they relay your voting desires to the investment management companies that hold them. And the relatively new engine number 1 vote ETF actually does vote on your behalf and in the proportion that you specify. So when we're choosing ESG investment strategies, all 3 of these would fall under an engagement strategy, and that would probably be a more effective means of trying to impact the social change.